Hello, everybody. We are live. Excited. We have here Josette, Caitlin, some good friends to talk about Texas. So, how are you? How are you doing, Caitlin?
Good. Thanks for having me today. Excited, as always, to talk tax.
And you, Josette,
All good,
doing
all good.
well?
Yeah. Thank you. Thank you for having me.
Oh, my pleasure. Pretty sure that people are really excited. We know that we joke that tax is not the most funny, interesting topic, but at the end of the day, they all want to listen a little bit. It's very important for the whole process of moving. So I can see some familiar names here. My good old friend Barry, Russ. We have Pedro. And guys, if you can let us know where you were from, where are you um, seeing this webinar, that would be fantastic. Just for us to have an idea if you are like in the early stage of your moving or already in Portugal, that would be fantastic. We have Miriam. So we have Lillian from Arizona. Good, good. So I guess we'll have many people that are in the state, and some of them probably will be already living here in Portugal and start to think about taxes here as we are getting close to the tax season. So you have here, oh, many people. So we have Don from New York. Will be in Portugal soon. Hopefully, yes. Marissa. Oh, there's so many people that like it's hard to read. We have Anna from New York, Jane, Boston. Really excited to cover uh, Texas. And thank you all for coming here. Really appreciate it. It's not that usual to see so many people talking to so quickly. We have Damon. Damon, nice to see you. You did mention you would be here, and you were here. It's good to know that, Damon. Yeah, so we can see people that are living in Portugal already. Coimbra, Campo, and some of them, like I would say that it seems like most of them are in the States. Uh, of course, we will talk not only about the US side of the text, but also the Portuguese one. So I hope you like it. We'll just wait for like 2 more minutes until we start this webinar. People are arriving. So and yeah, just more 2 more minutes and we start. So David from Cascais. David, do you like living in Cascais?
Who doesn't?
Um, true. Yeah, it's. I mean, if you can, it's good. It's yeah, nice place, nice beaches. Yes, Damon, we are recording this section. You will receive one email just as we close this webinar. You will have all of the everything that was uh, presented here. Okay, so seven. It's in Portugal. It's 7:05 p.m. So I guess I will start this webinar. So just 1 second. Let me try to share my slide. There you are. So we will talk about Texas in Portugal and in the United States. So it's a very holistic view of taxes, then that's one of the reasons why I'm so happy to put together so many good professionals together, and hopefully you will also like the what we will address in this webinar. So the planning is that we will start with the US side of the taxes with Caitlin. Then we move on to José, that who will talk about the Portuguese side, and then we will jump to the Q&A. Of course, we have few time to cover many topics, so we try to make it in a concise version so we can focus on what's more relevant for this topic. So, and if you, of course, if you have any question that's more specific, feel free to reach out to Caitlin, to José Guerra. But also, if by any chance your question is not answered in this webinar, you can always email me and I will address your question to the professional. But I mean, there's a lot to talk. So let me just do a quick introduction of who I am, and then we move to the taxes. Um, Many of you know me already. I'm Victor. I've been living here in Portugal for the last 7 years. I also had to go through all of the tax issue, so I know how, I mean, stressful it can be. So the fact that you are planning this process is really good. So you won't face, hopefully, you won't face any surprises. I'm one of the founders of Viv Europe, and basically we help people. Most of them are based in the United States to move to Portugal. And we help with all of the activities that are usually related to a relocation. So NIF number that José Guerra will talk a little bit about, bank accounts, real estate. So all of everything that can be related to a relocation, you can come back to me and we will do our best to help you out. But without no further ado, let me pass the mic to my friend Caitlin to cover the US side of Texas. Let
Excellent.
me
Thank you.
just try. Go ahead. Sorry.
Yeah, thanks for having me. I know the slides, will you kindly pull those up? Fantastic, wonderful. I'll start by introducing myself. My name is Caitlin Minot. I am a CPA and the CEO at Bright Tax. We are a U.S. tax firm, as you could probably imagine, as I'm here to present on maximizing tax benefits for U.S. expats. And there are lots of considerations as you move abroad, potentially to Portugal, or maybe you are already there. But today we're going to talk about the U.S. tax filing essentials, the really basics that you should know, but not everybody does, and ways to reduce your U.S. tax bill while you are abroad. So I'll get started by sharing at the high level that every American taxpayer who meets the minimum income thresholds has to file a return. These are the same thresholds that are relevant for somebody who is in the States. So I saw in the chat, many of you are already in the States, or still in the States, I should say. Others are in Portugal, but your tax filing threshold does not vary depending on where you are. Rather, by virtue of the fact that you have a US passport or potentially a green card, you have to file and report your worldwide income to the IRS every single year. The thresholds that appear here are relevant to 2024. The one that I always like to call out, and I think has some importance to mention, is the married filing separate threshold. Many U.S. taxpayers move abroad for love, and their spouse doesn't necessarily have a U.S. tax situation to work through and address. And in those cases where you're filing a separate return from a non-resident alien spouse, your filing threshold is just $5. So something to pay attention to, especially if you are already abroad and not sure if you have to file a U.S. tax return or not. Now, in addition to filing a U.S. tax return, there are also some requirements involved with your accounts located overseas. And I get the question a lot, why do I do this? Why does the U.S. Treasury want to know my bank accounts abroad? And the reason is that When you're stateside, the IRS has access to all of your information in your accounts, the money's going in and out of them. But when you move abroad, accounts located outside of the States don't quite have that level of, the IRS doesn't have that level of access to them. So as a result, you're required to file what's called an FBAR every year if you have more than $10,000 in accounts outside of the US. That could be hitting that threshold at any point during the year. So maybe you're moving funds to buy a property or a vehicle, or maybe you have a bonus that hits your account at some point and pushes you up over that threshold. So this relates to bank accounts, pension accounts, any sort of financial account that exists outside of the US will need to be reported each year on an FBAR disclosure. And while the FBAR disclosure does not drive any US tax, it does have pretty heavy penalties associated with it. So it's not one to miss. And it's certainly a threshold that you should be evaluating each year as you do your tax filing exercise. The other requirement to be aware of is something called the Form 8938. And that form is very similar to the FBAR in that you're reporting foreign accounts. It does have a higher threshold though, and it gets filed with your tax return versus as a separate disclosure like the FBAR does. So let's talk through filing deadlines. What are the important dates that you need to be aware of somebody who lives outside of the US? Some of these will be familiar, April 15th being one, because that's kind of the traditional tax day. That's what everybody thinks of as the big tax day for US taxes. And while when you live abroad, April 15th does still have importance, it's not actually your filing deadline. So it's not the date you have to file your return by. And when you live abroad, you have an additional 2-month extension to June 15th to file your return. Why April 15th is important when you live abroad is because if you owe taxes to the IRS, we always recommend paying by that deadline in order to avoid any sorts of interest associated with your tax bill. The FBAR that I mentioned is also due on April 15th, so that's another one to be aware of. If you don't file that on time, you do have automatically until October 15th to file it. Now, once June 15th has come and gone, you could potentially have an additional filing extension, which you have to proactively request from the IRS to obtain. And that one brings you to an October 15th filing deadline, reiterating that paying the IRS is important to do in the first part of the year with one of those first 2 deadlines to ensure you're not attracting any sorts of penalties and interest. And then there's a final December 15th extension that we can ask the IRS for. It's not ideal, but it is sometimes necessary, especially when your foreign tax return isn't done in time for filing by the previous deadlines with the IRS. Now, it is very, very common. In fact, I talk to taxpayers every day about not filing on time or not knowing that they even had to file while they are abroad. And for those of you who are stateside, this is certainly not your circumstance, but for those of you who already live in Portugal and have been abroad, if you are just realizing today that you have to file a US tax return, there's a way to get caught up called the streamlined procedure. We've done thousands and thousands of these with clients over the past decade or more, and it's a penalty-free way to get caught up. So that's a good one to look into if you're just learning that you had requirements that you have not been compliant with on a year-to-year basis. So knowing that, let's look at some of the ways you can reduce your US tax bill and the ways that the US tax code accommodates people who live overseas. The first thing I want to address is the misconception of a tax treaty. And while there is a tax treaty in place between the US and Portugal, unfortunately, every treaty has what's called a savings clause. And that savings clause essentially says that the US can tax its citizens as if the treaty had never existed in the first place. And I hear a lot people say, well, because of the treaty, I don't have to file a tax return, right? And unfortunately, the answer is no. The tax treaty doesn't necessarily have a big impact on, certainly not your filing requirement. And in very few instances, it can help to support and reduce your tax bill on the US side. But it's definitely not, as tax professionals, the first place we look when we're trying to eliminate your tax bill and create efficiency in your US tax situation. So if we can't use the treaty, what can we use? What is the way that we can reduce our US tax bill when filing my US tax return? Two of the most common mechanisms that we use as a firm on the day-to-day basis are the foreign tax credit and the foreign earned income exclusion. And these two tools are ways that you can eliminate double taxation, reduce your US tax bill, and they have different ways of doing so. The first is the foreign tax credit. This is the one that I, as a tax preparer, actually prefer to use and try to use first for all of my clients when I'm preparing a tax return. And what this does is it gives you a credit for the income tax paid abroad. So let's say you are a wage earner living in Portugal, and as a result, you're required to pay Portuguese tax. Now, what you would do is go through the exercise of paying tax on the Portuguese side, and then we can use the foreign tax credit on the US side to give you credit for what you've paid abroad. So this is a non-refundable credit, meaning the US government isn't going to give you a refund if you paid more in Portugal, but it does, in most cases, in many cases, reduce your tax bill to zero. On the other hand, here we have something called the foreign earned income exclusion. And the foreign earned income exclusion is a tool that many taxpayers are familiar with. I hear people say a lot, well, as long as I earn less than 100,000, I don't have to file a return, right? And the answer is no, but this $100,000 threshold is associated with this exclusion. And the exclusion essentially says that when you have earned income, so for example, a wage, self-employment income, or other actively earned income, you, because of the fact that you either permanently reside overseas or you spend a certain number of days outside of the US each year, can reduce and exclude your earned income from US taxation. The threshold for this exclusion is $126,500 for 2024. It'll go up to $130,000 for 2025. The catch with this exclusion is that you can't apply it for things like pension earnings, investment income, rental income, things that are what the IRS considers to be passive income. So it does have its limitations, whereas the foreign tax credit is something that can be a bit more widely used and applied, which is the reason we like to try it and use it first. So which is the tool that's best for you? Which is the right one to use in your circumstance? And the answer is, like many things when it comes to tax, is that it depends. Like I said, the foreign tax credit only works if you've paid foreign tax. So if you are under a tax regime that alleviates your filing and tax requirements abroad, then it's unlikely that the foreign tax credit is going to be a good tool for you to reduce your US tax bill. And it can only be applied to foreign taxes paid on foreign source income. There are some treaty provisions that blur these lines a bit, but generally speaking, if you have US bank interest, you can't pay foreign tax and then use the foreign tax credit to reduce your bill for that. The foreign earned income exclusion, it requires that you meet what's called the physical presence test or the bona fide residence test. So you're either abroad for 330 days a year, or alternatively, you have permanent residence outside of the US for at least a calendar year. And again, it can only be applied to earned income, so self-employment income, salaries, wages, etc. Something else to consider, especially for those who are self-employed. So maybe you have a sole proprietorship or you're running a small LLC as a pass-through entity. We have the income tax requirement, and we also have the self-employment tax requirement, also known as Social Security tax in the US. And there is a Social Security agreement, also known as a totalization agreement, in place between the US and Portugal, which eliminates the double taxation here. So this type of treaty specifically defines which country, whether it be the US or Portugal, is the system in which you should be paying self-employment tax or Social Security tax. And then when it comes time for benefits, how those are paid out, how the credits that you've earned over time then apply at the time of retirement. So high level, how to reduce your US tax bill and avoid penalties. Filing on time, paying on time are the two most important steps that you can take when approaching your US tax situation. There are also a lot of international disclosures that certainly aren't intuitive, or you wouldn't know that you have to file them unless you do some research and digging. But some of those include the foreign corporate disclosure. If you have a foreign company, any sort of foreign registered business, that's one that you need to pay attention to. A foreign partnership, similarly, it's another foreign registered entity that you would need to report and disclose back to the IRS every year. Foreign trust disclosures. So if you have a trust that's organized and registered outside of the US, this 3520 is going to be important. And then the FBAR and the FATCA. So the two disclosures that we talked about early on, reporting your foreign bank accounts, if and when you've hit those thresholds, are going to be really important. International disclosures in general attract a lot of heavy penalties. In themselves, they don't necessarily always drive tax, but the penalties associated with them. And again, filing them on time is the best way that you can ensure no surprises from the IRS and therefore penalties in filing your return. So that's it from me. I will pass the mic back to you, Victor, as you continue on to the next part of the presentation.
Thank you. Thank you so much, Caitlin. Very, very informative. And for everyone, if you do have questions, don't forget to type it in the comment section. We did receive already many questions, and we will cover them in the end. But if you have more questions, feel free to just type that. We will have our Q&A section in the end. And let me share now the mic with José Guerra for the Portuguese part of Texas. It's with you, my friend. Let me just share here the slide presentation. And there you go.
Very well. Thank you very much, Victor. Thank you, Kathleen, for your super informative session. It's always I always like to learn because, again, as I will end up my presentation, the interaction between the Portugal and the US side, or whatever two countries are being considered, especially when you are from the US, is super, super important. And I guess we'll have the opportunity to discuss that further. So, everybody, my name is Jose. I'm the tax partner at CCSL. It's a law firm based out of Lisbon. I've been working in tax and international tax for the past 20 years. And a lot of the work that I do in my practice is working with individuals that move to Portugal. So this sort of idea of looking into the Portuguese side of things, but with the focus or with the look or with the attention on the international aspect of their work. Of course, we don't do any US tax or other countries' taxes, but there's always this international tax aspects that people should be wary of. I'll try to be relatively short today in terms of what I'm going to be addressing, but I'm happy to cover any specific questions that you may have in the Q&A afterwards. So basically, the idea for today would be going into some general features of becoming a Portuguese tax resident. As far as I understand, for the most part, you are still in the stages of either in the process of moving or considering a move. So, I mean, what I've learned over the years is that there's a lot of misconceptions, as Caitlin was putting in the beginning. So knowing what you're going to be facing is important. I mean, just knowing what's going to happen is important. Before thinking of optimizing and whatnot, I mean, just know what your base is. Then the benefits that you could potentially look after, either the benefits for incoming residents or, as I call it here, other interesting features of the Portuguese tax system that may be seen as a benefit as compared to, namely, other options that you may also be considering. And finalizing with a few sort of a flags or for things that you should be attentive to or considering when going through all these discussions. So as a very, very general feature, Portugal taxes their residents, people who live in Portugal, on a worldwide taxation basis, as the US does in most other countries. And what that means is that if you are a Portuguese tax resident, then if you live in Portugal, for the most part, you are at some point in time, or you will become Portuguese tax residents, you will have to file a Portuguese tax return with any income that you earn anywhere in the world. So to some extent, there's going to be a duplication between what you report to the US and what you report to Portugal. My understanding from what I've learned over the years is that the extent of things that you report on the US side is typically broader. I mean, there's more reporting obligations to the US than to Portugal, but the main point to keep in mind is that, and again, as Caitlin mentioned in the beginning, and I'm 110% in agreement with what she said, and it's not a matter of opinion, by the way, which is, I mean, the fact that you report in one country doesn't mean that you don't have to report to the other when you're looking into Portugal and the US. and ultimately you'd be reporting to some extent the same types of income and the same types of things. And indeed, what I say here, don't fully rely on the tax treaty, is because indeed there's a tax treaty. Indeed, it helps you in terms of avoiding double taxation to some extent, but it's not, I mean, a lot of people have this conception of, well, I live in Portugal, I'm paying my taxes here, I don't need to pay in the US, or vice versa. I live in Portugal because this is US earned income and I already paid in the US, I don't need to do stuff in Portugal. And that's not the case. So keep that in mind. The other thing in terms of general features for Portugal is that Portugal and Europe as a block tend to have higher taxes than in the US. So like income per income, or for the same types of income and for the same amounts, generally speaking, the rates in Portugal and Europe in general are going to be higher than what you would expect in the US. So for what we call active income, so income from your work and pension income, you'd be looking at progressive rates potentially up to around 50% marginal rates, which it's quite high. On the other hand, for what we call passive income, so interest, dividend, capital gains for the most part, rental income, etc., you'd be looking at what I call acceptable rates, in the region of 28% flat rate. Again, typically higher than what you have in the US, but I guess for this side of the world, more on the acceptable side, and something that you just have to deal with. It is what it is. Indeed, Portugal has had for the past good number of years this regime called the NHR, standing for non-habitual resident, but that was ended in 2024. 23, 24, there was a transition period there, and that's no longer available. So I don't know if there's anyone here who still was able to capture the NHR. If someone did it, then on the Portuguese side, at least, that's very good news. But for the ones who didn't, it's not going to be, it's not an option anymore. And it is what it is. We just need to face the facts and work with what we have. So Portugal did replace the old regime with what is called the IFICI or TISRI. It's the English sort of a translation to it, or NHR 2.0, however you want to call it. And this is basically a replacement regime that does more or less the same. So the full idea is that in principle, you don't pay Portuguese tax on your foreign income. So it's sort of a materialization of this idea that if I do my things in the US, I don't have to do it in Portugal. It's not exactly the same because you still need to file in Portugal, but you would, if you qualify for this, you wouldn't have to pay the additional or the top-up Portuguese tax that you would have otherwise have to pay. However, unlike the old regime where everybody qualifies or would qualify for it, for this new regime, only people who come to work in Portugal in Portuguese companies in specific sectors qualify for it. And what this means, and again, happy to discuss that further, but without going into that many details, what this means is that the the breadth of people that can be covered by this regime is much smaller than before. So there are some structuring that can be done around, especially for people who are still active or who run businesses in the US, that we can to some extent replicate in Portugal. But for instance, it doesn't cover retired people and pension income, and some other things may be a little bit more complicated. So what else do we have that could make sense, or that could still make your move to Portugal work? So on the one hand, we don't have any estate or inheritance tax. So the sort of estate planning part of the discussion is much easier than the US. Also because of other legal aspects, but we don't have any taxes on that. We don't have wealth tax. So there's no, we only tax income. So if you have a bank account with €1 million and you generate little income from that amount, we don't touch whatever capital you have. We only tax the income. We also don't have gifts tax. And although this might be a bit of a niche kind of thing, but we have a broad exemption on income from or gains from crypto assets. Again, a bit of a niche market, but something that comes up every now and again. And this being said, what I always say is, of course, the NHR was a very good tool to play with and to plan because it was very simple and it was very obvious. But if that's not the case, there's still a lot of things that can be discussed, especially when you do this in conjunction with your US and your PT advisor, and also if you do it before, or if you start preparing things before you effectively move to Portugal. So I'll just give you a very quick and very easy and to some extent obvious example, but some of the things that come up and could be, I mean, small decisions, timely made, can make a difference. So for instance, you decide to move to Portugal. You know you're going to be selling your house, right? The house that you have in the US. Under Portuguese rules, your tax residency, we have partial tax residency. Your tax residency only starts in, say that you move in 2025, it only starts the day you effectively change your address with the tax authorities. That's effectively when it starts. And so what that means is, if you're going to move and come to Portugal, say in August, and you happen to sell, I mean, if you're going to sell your house and you're able to plan to sell the house before you move, say in July, you wouldn't have to pay any Portuguese capital gains tax on that property because you were not a resident when the sale happened. You would have to pay US taxes, I would assume, or whatever it is, the rules that apply, but you can avoid, and again, all of this is absolutely above board, you would avoid the Portuguese side of things, whereas if you sell it after moving to Portugal, you would need to, in addition to whatever US taxes you owe the IRS, you'd have to also pay taxes to Portugal, even if it's a sale of a house in the US, etc., etc. So, and there are other things. There are things that can be considered for people more on the retired spectrum of things, on the IRAs and 401ks that have accumulated over time. Some things can still be considered there, even if without this NHR 2.0, etc., etc. Last thing that I'd like to sort of stress or leave as a note before we go into the Q&A is two things. One is be aware of language differences. I mean, you may speak to someone on the Portuguese side who may be very fluent from a language point of view. I mean, the conversation may be easy, but I mean, make no mistake that the terms don't always mean the same. An obvious example is pension. When a Portuguese person like me, and again, I mean, I have some experience with this, but even myself on a daily basis, when I speak about pension income, for me, it's a broad term. It covers what you would call pension. It covers Social Security. It covers IRAs and 401ks to some extent, because that's how Portuguese law qualifies pension. And I've learned that it doesn't necessarily mean the same for the US, but there are other examples that you should be aware of, and make sure that you're very clear on the questions that you ask, and to make sure that you know that you're meaning the same things when you're using the same words. The other thing is integration. And I started here and I'm going to end here because, again, this is super important, especially on the planning stages and on the reporting stages, especially on the by country kind of thing. So it is very important that even if it's not the same firm, a lot of different or advisors from different firms work together. So for instance, we don't do US taxes. Of course, I mean, we have some people we work more often with, but I don't have any issues with working with whoever advisors the person has on the other side. For me, what's most important is that the advisors know what they're doing, and that they, to some extent, have visibility on what's happening on the other side. Also for you, a lot of the game, as Caitlin was mentioning in her presentation, is to do with knowing which credits to claim where. And if the tax preparers don't have visibility on what happens on the other side, they're not going to know this. So that's very important. And the other thing, it's by expertise, especially when we talk about the tax people and the financial advisors. It's important also that you give visibility to your financial advisor in the US about what happens on the Portuguese side, because he needs to know when making a financial or an investment decision, what the implications are going to be as a tax resident, that you are going to pay, or that you could end up having to pay some tax in Portugal. And ultimately, when he runs the numbers, he needs to have that cost in mind. And that's, I hope this wasn't too much information, but I also wanted to leave room for the more open discussion. Thank you, Victor.
Thank you, Jose. Also very, very informative. I'm happy to have both of you here, knowing that, and we had not so too much time to cover all topics, but you're very concise and cover many important topics. I'm having some sort of an issue with my internet connection, so if becomes difficult to understand what I'm saying, just let me know. I can repeat or I can pass the microphone to both Jose or Caitlin. But now let's move on to the Q&A. I will just try to uh, share my screen now. There you go. So there you go. So as I mentioned before, we did receive many questions when you sent the email about this webinar, which is fantastic. We knew from the beginning that this would be a very informative one. So what I'm gonna do here is there you are. I will first I will go to some of those questions that you've already sent to me, but also I will do kind of a mix and also read some questions that you are sending to us right now. So let's start with the US side. So first one, I heard there's something called the foreign earned income exclusion. How does that work?
Yeah, so the foreign earned income exclusion is one of the tools we can use to reduce your US tax bill. It only applies to earned income, so salary, wage, income, and it works through one of two criteria being met. So either you've lived abroad, let's use Portugal as the example, for a full calendar year, January to December, for abroad, and as a result, you can exclude up to a certain amount, about $126,000 of your earned income, right? Your salary, your self-employment income, and that's from U.S. tax. And the other option is that you simply spend 330 days outside of the U.S. during any 365-day period, actually. So that is a tool that can be used for reducing and eliminating U.S. tax.
Thank you, Caitlin. So let's move on to the Portuguese side. So, Jose, how do I know if I'm officially a tax resident in Portugal?
Okay, that's a very good question. So the first thing that I'd say is there's the residency discussion comes up very often, especially because you need to go through two different types of residency process. So the immigration and the tax side of things. So the first thing is make sure that you don't, it's different things. So residency for immigration purposes and for tax purposes is has different rules and has different requirements. From a tax point of view, what the law says is that you become a tax resident the first day that you land in Portugal. Okay? That's what the law says. Of course, that's a hard rule to apply. So in reality, what happens is that you become a tax resident as soon as you associate a Portuguese address with your tax number, with your NIF, with your NIF. So basically what the process goes, you need to do your immigration, you start to prepare the process. One of the first things that you do is you get your NIF, you get your bank account. When you get your NIF, typically you do it, you do it with someone else or with a tax representative, but you indicate your U.S. address. It's a non-resident NIF. After you come to Portugal, and once you settle in Portugal, you should at some point in time communicate to the tax authorities that you're here, that you have a Portuguese address, so that is associated with your NIF. The NIF, the number, the tax number will remain the same. So if you tell me the number, I don't know whether it's a resident or a non-resident number per se. So I would only need to know what the address is that is associated with that. But it's only when the address is changed that you effectively become a tax resident. So in reality, there's some leeway for you to time the moment in which you become a tax resident. I'm not suggesting that you play around with that, because again, keep in mind that the rule is, if the tax authorities could go back and say, well, it should be the first day that you landed in Portugal. But in reality, in practical terms, what I normally see people doing is, once they complete their immigration, when they go through their IMA appointment in Portugal, they would then do the conversion on the change of address on their tax number, and that makes them a tax resident.
Thank you, Jose. Really well explained. I did have this question when I moved to Portugal. So now I will read one of the cross-border question, and if any one of you guys can answer this, as it's basically related to both sides. And I know that this one is quite. I mean, many people do ask this question, and also Damon here can see that it was one of his questions that's related to timing.
Victor, can I just add something to what I was just saying on the residency for tax purposes and stuff?
For sure.
Just because I see it there. So Gina is asking, I was told you don't owe taxes on home sale in the US until you have residency card in your hand, whether that's true or not. And that's the point that I was raising. Residency for immigration purposes has nothing to do and does not trigger residency for tax purposes. Of course, I mean, if you get audited and you have residency for immigration purposes and didn't do the tax residency, there could be, the tax authorities could claim, well, I mean, if you're here, then you should have registered as tax resident. But on a day-to-day basis, from a practical point of view, you only become a taxable entity in Portugal, a tax resident, after you become a tax resident, and that's only after you change the address that is registered with the tax authorities with your tax number. So if you do that before getting your residency card, then you become a resident before getting your residency card. If you do it afterwards, after you get your residency card, then you only become a tax resident after you get your residency card. But again, it's not connected with the residency card. It's not connected with immigration residency. I'm sorry, it's just because I thought it's a good example illustrating what I was just trying to say.
Good point. Yeah, good point. So considering that this person now is a Portuguese tax resident, let's put this perspective in terms of timing. So should I file my taxes in Portugal first or in the US? Does it matter which one comes first? Any one of you can.
I'll leave it over to Kathleen, because I'm sure I'll agree with what she says, but
maybe, yeah, I think it depends is definitely the answer to this one.
Absolutely. Yeah.
It depends on where your income is sourced, which country has the first right to taxation on your income. Regardless, the US is going to need you to report your worldwide income on the return, but it's important that there's an integration between the tax strategy on both sides and ensuring that we're eliminating double taxation. So often we see, I'm kind of sharing the experience that I see, is that most often the Portuguese return gets filed first, and then the US return comes back. For Americans living in Portugal, that's generally the best way we can create tax efficiency, but it's not a simple black and white answer to this question.
I have to agree 100%. What I would add to that is that keep in mind that the Portuguese reporting system works a little bit differently. So both because of how the mechanism works and also because of timing. So the timings in Portugal, the tax season runs from April 1st to June 30th. And the way it works is figuratively speaking, of course, but you tell the tax authorities what your income was, and then they run the numbers, make the tax assessment, and come back to you with what the taxes are that you owe. Of course, I can run a simulation, I can make my own calculations, but in all honesty, the system is very opaque. So, and ultimately, for you to get final and official numbers, you need to wait for the tax authorities to come back to you. And what that means is that even if you file on April 1st, you would likely not get a response, or it would be hard to get a response from the tax authorities before April 15. So there's this issue of the extensions that Caitlin was mentioning earlier, and whatever arrangements need to be done on the US side.
Thank you. Thank you. Yeah. So moving on to the questions that you just sent us, and just let me emphasize that if by any chance we're not able to answer you, you can always email me. So starting from so Diana, she asks if does the Portuguese and US tax firm work together on my tax return? I guess, and I mean, it can be for both Portuguese or US side.
Yeah, I think you want them to. They should. There should be definitely a conversation to make sure that the strategies are coinciding and there's no double, we're eliminating double taxation as much as possible.
There you are. Thank you, Caitlin. So moving back to the questions that were sent before. So second one to the US side, how do I avoid getting taxed twice on the same income by both countries? I guess some of the we did cover already when in the presentation. So maybe move to the next one. So the tax treaty we did talk about it, so no need to repeat this. What is this? Maybe this one makes. I mean, we did not cover before. What's the deal with reporting for foreign bank accounts? Do I need to tell the IRS about my Portuguese bank?
Yeah, so that's where the FBAR disclosure that we talked about will come into play, and you should report any account that's located outside of the US. Banking, pension, investment, any sort of accounts, anything with an account number should be reported. It actually goes to the US Treasury versus the IRS, but it is something that we do during tax season. So it's often linked and associated with the tax filing exercise.
And again, on that note, the sort of the mirror of that to Portugal also happens. So in Portugal, on the Portuguese tax return, you also need to report foreign bank accounts. Again, the extent of the reporting is much narrower than for the US, for US purposes, but you also need to report foreign bank accounts. And as of this year, last year, you also need to report foreign assets from a Portuguese tax point of view.
Thank you so much. Moving back to the Portuguese aspect of the taxes, I mean, Jose did speak about the NHR. I did receive many questions about the new NHR. Jose covered really well the IFICI, but we did already cover that in the presentation. Let me see if there is some. Yeah. I mean, this is an easy one, but it's very important. So the last one for the Portuguese side, should I hire tax assistant before or after moving to Portugal? What's your opinion, Jose?
Yeah. Assuming you will hire tax assistants, because I mean, if the question is whether you should hire, I mean, I'm biased to answer that question, and you know what the answer is going to be. But if it's a timing question, I mean, with taxes, once it's done, it's done. So for sure, before moving, we have a lot to discuss, and we can ultimately you can end up saying, okay, so I understand what the impact is going to be, and I rather not move to Portugal because the impact is going to be too high. If you don't have that discussion, once you're here, it's going to be too late to find that out. And on a more sort of a joyful note, I think it's the same for planning for efficiency and optimization, and also again on the US side, I'd say the same. Yeah.
Thank you. So let me try to choose one of the questions that were not mentioned before, and so yeah, this is one that both of you covered, but I think it makes sense to emphasize. What happens if I mess something up or forget to file one of the taxes related to one of the countries?
So on the US side, we have a mechanism called the amended return that we can use to go back and fix an error that was made on the tax return. I think the biggest risk, as Jose said, is that when we are proactively planning, we're able to tell you what the impact of your decisions are and let you know that, selling your house at this time or disposing of an asset at this time is going to have this impact in the US side and the Portuguese side. So I think it's there's not as much of a risk in making an error on the tax preparation as there is not understanding the consequences of your financial moves and your actual move itself. But if you have not filed something on the US side, you just didn't know you had to file, or the FBAR is something that you just learned about today, there are penalty-free ways to get caught up on the US side that we use all the time to help people correct mistakes or get back into the system. So really understanding what the tools and procedures are associated with that, the streamlined procedure that I talked about earlier being one of them, can help you get back in the system. At least on the US side, the IRS kind of opens the doors to those compliance efforts versus trying to catch people as they fix their mistakes. So working with somebody who understands how to do that in a penalty-free way and really get it right the second time, in that case, will be important.
Thank you, Caitlin. Okay, so let's move on to the next question from the comment bar. So this one from Donna, it has to do with the exchange rate and reaching that milestone to start having to file the FBAR. So if you pop over 10K due to the rapidly changing currency conversion, but lower your balance quickly, do you still have to file the FBAR?
Yeah, you do. So if your balance the currency fluctuation, or I have clients who they take out a loan and the loan goes into their checking account before it goes to pay for their house, and that trips the threshold. It does require an FBAR and sometimes an 8938 form. Both of those disclosures don't drive tax, so you're just reporting. It's not going to attract any tax or any liability to the IRS. It is important that you do that and are as forthcoming as possible with foreign bank account reporting.
Thank you. So let me try to find one related to the Portuguese side in the comment section. Okay. And maybe this is more like generic one from Barry. So I'm married, I'm a resident, my wife isn't. I guess it means in Portugal. All my income is self-employed and social security. What is the best way to file taxes? Joint, separate, which to file for? The which to file first we did cover before. But in regards to filing the tax separately or in a joint way, which is the best way, at least in Portugal, in your opinion, Jose?
Sorry. So I think, I mean, going to the question, it's only the option only exists if both people are residents of Portugal. So if one of the persons is not a Portuguese tax resident, then you cannot file jointly. If both are Portuguese tax residents, you have the option every year to choose whether to file jointly or separate. And the choice that you make in 1 year doesn't affect your ability to make a different election in the following year. In any case, it depends very much on the specific numbers. Typically, what we do is we try to run the numbers, and it's a decision that we make or that we suggest the person to make on the basis of what is better in the specific context. But I mean, what we normally see is that if there's a big discrepancy in the level of income between one person and the other, typically it's better for them to file jointly because it evens out and the tax rates tend to be lower. But again, it very much depends on the numbers, and it's an option only available for if the two people are tax residents of Portugal.
Thank you, Jose. Thank you very much. So we are reaching the 1 hour time. So let me just focus on the question that you did send today. Maybe there's time for one or two more. Let me see here. Okay. Also, if that's too specific, you can let us know, and then they can send the question to your email for both of you, just like Caitlin. So let me get this one from Damon. So I'm working remotely in Portugal for a U.S. company. If I had federal and state taxes already deducted from my W-2 job, are those all refunded if I pass to bona fide resident test? Would that make me liable to Portugal for taxes? So taxes related to the company in
Yeah,
the
that's a
US.
great question. So when from a US tax perspective, if you're working remotely in Portugal, regardless of where your company is based, where the money goes, what currency you're paid in, you are sitting on Portuguese soil and generating income as a personal individual. And as a result, your income is considered to be Portuguese sourced income. And when you have Portuguese source income, then you have the availability of these tools that we talked about, the foreign earned income exclusion, the foreign tax credit, to potentially reduce your US tax bill. So in this case, Damon said that he passes the bona fide resident test, meaning he's been a resident in Portugal for at least 1 calendar year. So I'm going to make the assumption, for purposes of the example, that your income is 100,000 US dollars a year. And if that is the case, we can exclude your entire income from US tax. And what that's going to do is mean that the income tax withheld at the federal level on your US tax bill is likely to be all excess payment withholding. So will this generate a refund on the bottom of your return? It depends on what your other income sources are. I don't want to oversimplify the example, but in theory, if that was your only income, then your US withholding would potentially be fully refunded to you on your US federal return. At the state level, it depends. So depends on if you're still a state tax resident. It depends on where you lived previously. Some states recognize that foreign earned income exclusion that we talked about that can be utilized at the federal level, but STEM states won't. So California is a great example where if you maintain California state tax residency and move to Portugal, one, California is going to make it really challenging for you actually to cut ties with the state of California. And two, they're not going to recognize that foreign exclusion or the foreign tax credit necessarily. So you actually end up paying state taxes at the California level in this example, as if you had lived in California for the entirety of the year. So there's variation between federal and state levels. But at the federal level, there is the potential that you would get a full refund for all the withholdings. There are ways to avoid the withholding being taken in the first place. You would need to discuss that with your company and pause withholding if possible. But I do not know how that interacts with the Portuguese tax system and how your tax liability would be created in this example. So I'll pass the mic over to our Portuguese expert to ask that side of the question.
Yeah, I think, you would obviously have to consider the Portugal. I mean, you would be subject to tax in Portugal depending on what your specific regime would be. That would be active income. So if you don't have any special tax status, you'd be subject to progressive rates that would, for the numbers that Caitlin was exemplifying, you would be at the marginal top rates. Again, it's progressive rates, so it's not that it would be 50% on all of your income, but again, marginal rates of around 50%. In this case, should be around 48%. If you do have the NHR 2.0, and if this income qualifies for it, then you could apply for either a full exemption or the 20% reduced rates. But all of it, but again, Portuguese taxes would apply because, as Caitlin mentioned in the beginning, you would be a Portuguese tax resident with income that would be considered as Portuguese earned income, because the relevant aspect is that you're here physically while doing the work.
Thank you. Thank you. Very well explained. I do have one question. Um, that is, what is the best way for people to contact you guys, Jose, Caitlin, in case they need your assistance? Let me put you on the screen.
Absolutely. So hello@brighttax.com is the best way to reach me and my team, whether it be for questions, consultations, proactive planning. We'd be happy to help.
Yeah, in my case, I mean, you can reach me out directly on my email. I don't know if Victor or Victor directly. I mean, happy to also, you have Victor's contacts, and either directly with me, I can leave my email here, or through Victor. Happy to also help.
And guys, I cannot thank you enough for being here to this excellent presentation. Really, really, really well um, informed. All content that you were able to share. Really, really happy. Thank you, Caitlin. Thank you, Jose.
Thank you.
And for everybody here, don't forget that you still can send me your questions. I'll do my best to address them to the professionals. And this video will be recorded. So if you want to share with any of your colleagues, people who are maybe thinking about moving to Portugal but are a little bit scared about the tax part, feel free to share with them. And thank you. Thank you. Thank you, Caitlin. Thank you, Jose.
Thank you, guys. Enjoy your weekend.
Bye.